Hello everyone and welcome to video channel of Kautilya IBS Mumbai. Today we will deep dive in the concept of valuation. What is valuation? Valuation is the process of estimating fair market value of an asset considering all relevant factors. Imagine you are at a flea market and see a old laptop. The seller asks for rupees 20,000 but you have no idea whether it's a fair price. Valuation helps answer that question.
Now, let's explore the three main approaches to valuation: market approach or relative valuation approach. This compares similar assets that have recently been sold. Imagine finding the similar laptop at another booth for rupees 15,000. That gives you a good benchmark for negotiation. Example: a stock analyst might compare a company's price to earnings ratio with its competitors to see if it's overvalued or undervalued. Income approach or the intrinsic valuation approach is a general way of determining the value of a business by converting anticipated economic benefits into a present single amount. Cost approach estimates the cost to replace the asset with something of similar utility. In our example, if the keyboard of the laptop is not functioning and parts are expensive to replace, then obviously it might not be worth rupees 20,000. Example: real estate appraisers often use the cost approach to estimate the cost of rebuilding a property from scratch.
Now let us discuss the difference between enterprise value and equity value. Enterprise value and equity value are two key metrics used to assess the overall financial health and worth of a company. However, they look at the company from different perspectives. Here's a breakdown of the key differences. Enterprise value. It represents the total value of a company considering all its capital providers. It takes into account both equity owned by shareholders and the debt used to finance the company. Equity value. It represents the net worth attributable to the shareholders of a company. It solely considers the market value of the company's outstanding common stock. Hence, the key difference is enterprise value considers the entire company as a going concern, including debt, while equity value focuses solely on the shareholder's stake. Enterprise value includes debt and cash, while equity value only considers equity. Enterprise value is used in mergers and acquisition transactions to determine a fair acquisition price for the entire company, considering its debt structure. It also useful for comparing companies across industries with different capital structure. Whereas equity value is more relevant for existing shareholders interested in the total market value of their ownership stake in the company. Enterprise value is equals to market capitalization plus total debt minus cash equivalents. Hence, enterprise value provides an idea of how much an acquirer would need to pay to buy the entire company, including its debt obligations. Imagine a house. The equity value would be the market value of the house itself. The enterprise value would be the market value of the house plus any mortgages outstanding on the house. However, companies with high debt levels will have a larger difference between enterprise value and equity value. Both metrics can be used alongside other financial ratios to get a more comprehensive picture of a company's financial health and value.
What do you mean by intrinsic value and market value? Intrinsic value represents the estimated true worth of an asset based on its fundamental characteristics and future earning potential. Intrinsic value focuses on the asset's internal factors like future cash flow, assets, liabilities, and competitive advantage. Example: imagine a company with strong brand loyalty, low debt, and a solid track record of earnings. Even if its stock price is currently low, its intrinsic value might be high due to its potential for future growth. Intrinsic value can be estimated using various methods like discounted cash flow analysis, which considers the present value of an asset projected cash flows. Market value refers to the actual price an asset is currently trading for in the market. It focuses on supply and demand from investors in the market. Market sentiment, news, events, and overall economic conditions can all influence market value. Example: a company's stock price might be high due to positive news or investor hype, even if its underlying financials don't necessarily justify that price. Market value is simply the price at which someone is willing to buy the asset from someone else who is willing to sell. For publicly traded stocks, it's the current stock price. So, what are the key differences between market value and intrinsic value? Intrinsic value is an estimate, while market value is a realized price. Intrinsic value looks at the asset's fundamentals, while market value reflects investor behavior. However, there's no perfect way to determine intrinsic value, and it's an estimate based on assumptions. Market value can be volatile and may not always reflect an asset's true worth. Investors often use a combination of intrinsic value and market value analysis to make informed investment decisions.
If you like the content, do like, share, comment, and subscribe.